Test, raz, dwa, trzy. Słuchajcie.
Masz pomysł na kolejny film?
Słucham?
Masz pomysł na kolejny film?
Tak,
Nie.
ale już muszę go opisać i ten.
Ale wyciskać coś na swoim koncie? Może działać coś.
Wil je muziek luisteren nog leuker maken? Als je Spotify Premium neemt, kun je Smart Shuffle gebruiken om aanbevolen nummers aan je playlists toe te voegen. Of start een jam. Nodig vrienden uit om samen playlists te maken en er nummers aan toe te voegen, inclusief onbeperkt overslaan
GPV
en
odpala.
spelen. Tik op de banner voor meer informatie.
Będzie ładnie. US. Słucham?
A ładowarka w ogóle nie ma.
Co, musisz nowe słuchawki kupić lepsze, co? No, tu sobie wczoraj wyrysowałem na wykresie, jak to mniej więcej mogłoby pójść i trochę się z tym zgadza. Hmm. Ścigać chcę. Nic się nie dzieje na razie. Wywanie, przeglądarka. To lepiej zrobić po prostu przechwytywanie okna. Web. Wybierzemy sobie grę. Pyk. Pyk.
The famous investor Paul Tudor Jones once said that the 200-day moving average is the first indicator he looks at. Why is that? In this video, we tell you why Tudor Jones looks at the 200-day moving average and why it's a useful trading indicator. We show you trend-following trading strategies as shown on the screen and how you can use the 200-day moving average as a filter for short-term mean reversion strategies. First, let's show you how the average looks on a chart. The red line is the 200-day moving average, and it moves up after the price has gone up. Thus, it's a lagging indicator. We also spot that there are many whipsaws when the price moves sideways, which is a problem for all moving averages. Now let's look at why Tudor Jones uses the 200-day moving average as a trend filter. We're only invested when S&P 500 are over its 200-day moving average, and we sell when it ends below the average. Since 1960, this simple strategy has performed well. Excluding dividends, the return is 6.75% compared to buy and hold 7%. What makes the strategy good is that you have smaller drawdowns compared to buy and hold. Max drawdown is only 28% compared to buy and hold's 56%. The reason for the reduced risk is that you avoid some of the worst bear markets. For example, the chart on the screen shows how you sold out in late 2007 and avoided the bear market of 2008 until you re-entered in 2009. You avoided a 55% loss. When the dust settles, you start compounding from a higher level. This is why Paul Tudor Jones uses the 200-day moving average. If the price is above, it's a bull market, and when the price is below, it's a bear market. It's a simple concept. But in trading and investing, simplicity helps you a long way. Let's look at how you can use the 200-day moving average to filter out when to take short-term trades. We use a standard mean reversion strategy to buy when the 5-day RSI is below 35 and sell when it rises above 50. We backtest the ETF that tracks S&P 500, SPY, since its inception until today. Albeit a rising curve, you would have experienced pretty tough setbacks. The trading metrics are not bad, but max drawdown is pretty high at 29%. We suspect most traders would have quit the strategy after such a loss. What happens if we add a 200-day moving average filter? The strategy is the same, but the close needs to be above the 200-day moving average to generate a signal. Adding the trend filter smooths the returns, the 200-day average filters out volatility, and makes it easier to follow the strategy. The number of trades go down, but the average gain per trade and win rate go up. The win rate is an important metric because of the human bias to suffer more from a loss than an equal win. If we turn the trend filter upside down and only take trades that are below the 200-day moving average, we clearly see that the performance is more erratic compared to when it's above. That makes sense because history shows that volatility is twice as high under the 200-day moving average than when it's above. Can the 200-day moving average strategy be improved or made different? Please comment if you have suggestions. Good luck trading.
In this review, we look at another stock trading legend, Paul Tudor Jones. Jones made the Forbes 400 rich list in 2020, increasing his wealth from $5 billion to $5.8 billion over the previous year. Also ranking at number 13 amongst the richest hedge fund managers in the world. The Wall Street Journal also called him the most watched, most talked about man on Wall Street. Known for being a contrarian type trader, we look at Jones' philosophy of going against the crowd and his path to becoming one of the richest men alive. Jones was born in 1954 in Memphis and later graduated from Virginia University in 1976 with a degree in economics. Initially employed as a clerk on trading floors where he stayed for 4 years, Jones was later employed by the commodity broker Eli Tullis, where he was mentored in the trading operations of the New York Stock Exchange. In early 1980, Jones decided to start his own investment company called Tudor Investment Corporation. In the year 2017, the firm was estimated to be managing $17.7 billion worth of investments. Throughout the years, Jones has acquired a specific philosophy when it comes to trading stocks. Often referred to as a contrarian approach, he looks for the market to be at a turning point, whether that is a top turn or a bottom turn. Paul says, "I believe the very best money is made at the market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all your money by playing the trend in the middle. Well, for 12 years, I have been missing the meat in the middle, but I have made a lot of money at tops and bottoms." One of the key criteria Jones uses to ensure he's on the right side of any turn is the 200-day moving average. In fact, he says, "My metric for everything I look at is the 200-day moving average of closing prices." In theory, Jones is not looking for the highest or lowest point of a trend. He is really looking for a confirmed turning point. His confirmation of a turning point is the crossing of the 200-day moving average, therefore avoiding the catch of what is often referred to as a falling knife. It is important to distinguish between picking the high or low as opposed to a true market turn.
Ale wszystko spadło.
Many of you will rightly relate Jones' trading philosophy to that of a swing trader, a similar concept we covered in a previous video. Jones gained popularity when he predicted the stock market crash of 1987, also known as Black Monday. The crash caused huge panic across the world markets, with indices falling more than 20% in a day. Jones, however, knew that the 200-day moving average was a key indicator, and price crossing the line would signal a falling market. He not only sold his positions, but shorted the market, and in the process his fund grew by almost 200% that year, whilst others lost fortunes. From a technical standpoint, we could have seen this crash earlier than using the 200-day moving average alone. For example, in April, we see the same double top as September. We also see the same bounce 2 weeks later. This followed another bounce, causing a double bottom over both periods. Both periods then saw another bounce, followed by a decline, and at this point both technical patterns looked almost identical. Although in May we had a confirmed third bottom, followed by a considerable recovery. In October, however, the price attempted to bounce but failed, falling below the support line, and the rest is history. The ideal time to short the market would have been at this break, with a stop loss placed above the failed bounce. The eventual risk-reward on such a setup would have been considerable. Risk-reward is another highly regarded rule which Jones not only applies, but teaches to students at the University of Virginia. Jones looks for a minimum risk-to-reward ratio of 5-to-1, therefore he is willing to risk $1 to make $5. Applying this concept means you can be wrong 80% of the time without losing any capital. Let's put this concept into a diagram to better understand the theory. Here we have price, and here time. It is important to note that the concept applies to any time frame. We decide to buy a stock at $10, and we are willing to accept a 10% loss per unit. This provides the $1 risk per unit. As time progresses, the stock price could either rise or fall. Remember the adage of cut your losers short and let your winners run. This concept forces that highly important discipline. Jones says, if I have positions going against me, I get right out. If they are going for me, I keep them. Risk control is the most important thing in trading. If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. Applying Jones' risk-reward concept and combining it with the 200-day moving average rule is fundamental to his method. Let's apply this method to the market crash we saw starting in February this year. Here we have the 200-day moving average line. At the end of February, price crossed and closed below the line, and in theory Jones would have sold his positions. The following few days saw a failed bounce above the line, and it's possible Jones would have seen the close of price on the fifth day as an opportunity to short the market. Like the previous chart, a stop loss could have been placed here just above the tail of the previous candles, again creating a great risk-reward opportunity, whilst others saw their buy and hold accounts plummet. Here we can see 10 of the previous major market crashes from 1969 to 2009, ranging from drawdowns of over 20% to a huge 72%. But how would the 200-day moving average rule that Jones applies impact these drawdowns? Let's take a look. I managed to find a snippet supplied by Bloomberg covering 6 of the previous market drawdowns. The red bars show the total drawdown for each given period, and the orange bars show the drawdowns prior to price dropping below the 200-day moving average line. The average maximum drawdown for each of these crashes equates to just over 35%. By applying the 200-day moving average rule, the average drawdown for the same period equates to just over 6%. Clearly, although only part of the equation, the 200-day rule is very effective in regard to risk control, another aspect Jones holds in high regard, and he says, "I'm always thinking about losing money as opposed to making money. Don't focus on making money, focus on protecting what you have." Jones is an exceptional risk manager and points to a simple indicator to judge if you're risking too much. He says he never wants to be in a position where he is scared to open his account and find huge losses. And if you have this feeling, you need to tighten your risk management. Again, entering a trade with a risk and reward approach and combining with the 200-day moving average rule is fundamental to Jones' method and should, by default, support with managing risk. It was interesting to read that Jones first took an interest in trading when he read an article from Richard Dennis. Dennis is widely known for the turtle, trend-following strategy, which we covered in a previous video. There are certainly elements of Jones' strategy which are
Turtle trade. Fajny kanał. Wyciągnę. Fajne filmy, kurde.
line to that of the turtles, and trend following is clearly one of them. In fact, Jones said to his students, "You don't need to go to business school, you've only got to remember two things. The first is, you always want to be with whatever the predominant trend is." His second piece of advice was again the risk-reward approach. Jones's use of the phrase predominant trend is also important. We know he refers to himself as a contrarian trader who looks for a turn in the market, but the turn must be in line with the overall trend. We can interpret this to be what is commonly called a pullback. At this stage, we can put all the pieces of Jones' philosophy together. We have the overall predominant trend, a pullback within the trend, price above the 200-day moving average, and this could be price crossing above or remaining above the moving average line. And again, his risk-reward approach, to which Jones says, "I look for opportunities with tremendously skewed reward-risk opportunities. There's no reason to take substantial amounts of financial risk ever, because you should always be able to find something where you can skew the reward-risk relationship in your favour." All in all, a rather simple philosophy of cutting losses and staying with the trend. A young Jones was asked a profound question by his tutor, Eli Tullis, which influenced his trading to this day. He said, "The markets will be there in 30 years, but the question is, will you be?" The message reinforced Jones' capital preservation stance and resulted in him taking advantage of the many market trends over the years. A great book from a true stock trading legend. Thanks for listening.
problem.
The complete turtle. Hi, in today's video we Trader by Michael Koval. The true story of how 23 novice investors became overnight millionaires. Market wizard Richard Dennis, the trend-following pioneer, discloses his mid-1980s turtle trading experiment, where his group of novice traders strictly followed his rules and over a 4-year period made $150 million. We take a glimpse at the story, the stats, and learn what we can from the trading system. Richard Dennis started from humble beginnings in the early 1970s, starting as a runner on a trading floor at the age of 17, and a few years later, he traded his own account. He originally borrowed $1,600 and spent $1,200 on a seat at the Mid-America Commodity Exchange. He soon turned the remaining $400 into $3,000 in a short space of time, and between 1970 to 1973, he turned his equity into $100,000. A year later, he returned a profit of $500,000 trading soybeans, and by 1975, he was a millionaire at the age of 26. Dennis later formed a partnership with fellow trader William Eckhart, a PhD mathematician who also successfully applied his knowledge to the stock market. Both Dennis and Eckhart fell into a philosophical disagreement. Dennis believed that his trading system could be taught to anyone providing there were a set of rules, whereas Eckhart disagreed. The argument became a catalyst towards the creation of the Turtle Trading Program. The name was inspired by a previous trip to Singapore, to which Dennis said, "We are going to grow traders just like they grow turtles in Singapore." Soon after, their firm C&D Commodities placed this advert into the Wall Street Journal, Barron's, and the International Herald. The point of experience not being necessary is the key takeaway from the advert. We will learn shortly that the group were far from experienced traders. In total, there were more than 1,000 applications to take part in the experiment. The experiment would provide 2 weeks training, and each would be provided with a $1 million account to trade with. The successful applicants had varying backgrounds, including a blackjack player, a computer game designer, a pianist, and an Air Force pilot. The group went on to earn over $150 million, which suggested that Dennis's theory was right. You could teach anyone to trade provided they were given the appropriate training. Or put another way, trading is learnable and not an inborn talent. In January 1984, during the 2 weeks of training, Dennis and Eckhart focused on teaching the foundation of their trading style. The theory and concept of their style was hugely important. It was never about numbers moving up and down on a screen. There had to be a theory behind the method. Dennis went on to say, "You need the conceptual apparatus to be the first thing you start with, and the last thing you look at." The turtles were taught to think of themselves as scientists first and traders second. The trading outcome was simply a result of the laws of reasoning. This thinking put Dennis ahead of his time, and years later, the academic Daniel Kahneman, author of Thinking Fast and Slow, won the Nobel Prize for Prospect Theory, also known as behavioral finance, which encapsulated Dennis's prior teaching. Fortunately, after a 10-year contractual secrecy pact ended in 1993, we have been able to gain access to the rules of the system. Let's take a look. Although we disclose the rules here, it's important to point out that a successful system is more than just a set of rules. Dennis says, "I always say that you could publish my trading rules in the newspaper, and no one would follow them. The key is consistency and discipline. Almost anybody can make up a list of rules that are 80% as good as what we taught our people. What they won't do is give them the confidence to stick to those rules even when things are going bad." With these rules, confidence and discipline, embedded over just 2 weeks of training, the turtles earned an average annual compound rate of return of 80%. The turtle trading system had no room for subjective decision-making. It was considerably mechanical, promoted consistency, and eliminated any form of subjectivity.
Co?
We evaluate the turtle system against the following components. The turtles traded commodities, more popularly known today as futures, but the most important criteria when considering the future contract was the liquidity of the underlying market. Due to the amount of money being placed into the market by the turtles, anything with a low trading volume would have made entering and exiting positions extremely difficult. This leads us on to position sizing. Turtle trader Curtis Faith said, "Position sizing is one of the most important but least understood components of any trading system." The turtles were taught a concept called N to represent underlying volatility of a particular market, and once N had been determined, the position size could be calculated. Therefore, although the position size was a fixed percentage, it was also volatility-based. The calculation of N is simply a 20-day moving average of the true range, commonly known today as the ATR, or average true range. The turtles used a position size calculation based on 1N equaling 1%. Therefore, if N was determined to be 2 for a particular market, then the position size would be 2% of account equity. The turtles called...
To jest to. Masz chwilkę?
No.
Więc ci traderzy, turtle traders, nie?
Jak?
Turtle
No.
traders. Wiesz co to jest?
Mhm.
To mieli zasadę, że używali ATR, 20 day moving average, ATR, i na podstawie tego, jakie ATR było, na jakim poziomie, taki robili stake size. Czyli przed ATR, bo było na poziomie 1%,
Mhm.
to ryzykowali 1%, a jak był ATR na 2, to 2% ryzykowali. Wiesz, nie?
No.
Okej, to wszystko. Taka ciekawostka.
called their position sizes units, and the formula is seen here. The maximum amount of units that could be traded on a single market was 4. The strategy also included the adjusting of account size. Therefore, if the markets were not moving as hoped, the notional account size would be adjusted to suit. For example, if the account size was originally $1 million, but the account lost $100,000, equaling a 10% loss, the turtles would base their next trading position on an account size of $800,000, or a 20% loss. So for every 10% drawdown, the turtles would trade based on a theoretical 20% drawdown. This would help protect capital, should the markets continue to trend abnormally. The next component of the turtle system is the entry, and contrary to popular belief, the entry criteria for the turtle system is far from complex. It was based on the channel breakout systems taught by the notorious Richard Donkian, commonly known as the Donkian's channel breakout system. There were two systems to choose from, a shorter-term system based on a 20-day breakout, or a longer-term system based on a 55-day breakout. Some traders chose one system, whilst others chose a combination of both. An interesting point to make is that the turtles did not wait for the close of the day to determine if the price remained above the breakout point. They would enter the trade as soon as the price broke the time frame being measured. They would trade in either direction by buying the high or selling, going short, on the low. The turtles were told to pyramid the trades thereafter. For example, for every 0.5% change in price after breakout, the traders would add another 0.5% of their account to the position, up to a maximum 2%. The turtles were told to be very consistent with the entry. The next component of the turtle system is the entry, and contrary to popular belief, the entry criteria for the turtle system is far from complex. It was based on the channel breakout systems taught by the notorious Richard Donkian, commonly known as the Donkian's channel breakout system. There were two systems to choose from, a shorter-term system based on a 20-day breakout, or a longer-term system based on a 55-day breakout. Some traders chose one system, whilst others chose a combination of both. An interesting point to make is that the turtles did not wait for the close of the day to determine if the price remained above the breakout point. They would enter the trade as soon as the price broke the time frame being measured. They would trade in either direction by buying the high or selling, going short, on the low. The turtles were told to pyramid the trades thereafter. For example, for every 0.5% change in price after breakout, the traders would add another 0.5% of their account to the position, up to a maximum 2%. The turtles were told to be very consistent with the entry rules, knowing that most of the returns come from a minority of trades. So if one trade was missed, it could have a huge impact on profits. An expression commonly used is, there are old traders and there are bold traders, but there are no old bold traders. Traders that don't have stops go broke. The turtles had a predefined risk on every trade. This was non-negotiable. The maximum exposure to any position was 2% of total equity, or 2N, when accounting for volatility. Additionally, any pyramided positions would also have the stops raised, therefore ensuring maximum exposure always remained at 2%. Due to the size of funds traded, however, the turtles did not enter the stop-loss position with the broker. They did not want to reveal the positions to the market. Instead, the stop-loss figure, although predefined, was not entered until price reached the price set. Since the stops were based on N, i.e. adjusted for volatility, volatile markets had wider stops and less risk per contract. This reduced risk across all positions and gave improved risk management. Another old saying suggests, you can never go broke taking a profit. But knowing that the turtles were trend followers, this would have often meant taking profits too early, which is one of the most common mistakes when using trend following systems. Take this trend as an example. Many traders would have perhaps taken their profits here, after a spike in price, or possibly here after a pullback. The temptation for either exit is often too great. Of course, every trading system is different, and exiting at these points could make sense for the concept of your system, but for the turtles' trend-following system, this would have led to poor performance. So how did they exit a profitable position? Again, the exiting rules were not complex, but allowed for the capturing of a full trend. System 1 exit was simply a 10-day low. Therefore, if a 10-day low was experienced at any point in the trend, the position would be exited. Likewise, System 2 had a 20-day low exit. In terms of complexity, they were simple rules, but in terms of the psychology and discipline, following such rules is very difficult. At times, these 10 and 20-day rules would see large profits evaporate in a comparatively short space of time, especially if the chart looked more like this. Dennis said, "A good trend-following system will keep you in the market until there is evidence that the trend has changed." These exit rules provided the evidence, and the turtles would exit without hesitation. Before we move on to some of the results produced, this comment from Dennis summarizes his thoughts. Trading was more teachable than I ever imagined. Even though I was the only one who thought it was teachable beyond my wildest dreams. In 1989, the Wall Street Journal produced an article showing the results of 14 turtle traders taught by Dennis and Eckhart. Here we have the range of annual results for each trader, and here the average annual returns for 4 years of trading. Notice how Stig Ostgaard achieved a staggering range of between 87% and 296% per year. The average return of all turtle traders equated to 80%, whereas the Barclays CTA index, which reports the results of 110 advisors holding more than 4 years' experience, achieved an average of 25%. The S&P 500 returned 19.2% in comparison. Each of the turtles would keep 15% of the profits, whereas Dennis and Eckhart would keep 85%. Clearly, the teachings from Dennis and Eckhart provided huge performance benefits, with each of the turtles achieving considerably more than popular benchmarks. In summary, it was proven that in such a short period of time, someone with no prior experience could be turned into a professional trader. The turtles understood the concept of a simple trend-following system, and by applying good risk management, sticking to the rules with unquestionable consistency and discipline, outstanding results could be achieved. A great story for inspiration, achieving 5 stars. Thanks for listening. Please hit the like button, subscribe, and as always...
Ciekawe.
Welcome back. Welcome back.
Co się dzieje z tym rynkiem? Dzisiaj nie ma nic, nie ma nic. W ogóle nie ma tradingu. Caramba. Ay, caramba. Ale nudy na tym rynku są dzisiaj. Dzisiaj są nudy. Tak jak wczoraj. Nie. Tak slow. Ja myślę, że będzie spadał. Dlaczego patrz? Przyszły ani się, patrz. Tutaj mamy jedną nogę. Rites, druga noga. Ja nie słuchać jak mówię do ciebie.
Ale nie, bo jak najpierw gadasz.
Co ty się cieszysz i się śmiejesz, że Ańka do ciebie, co? I co? Co się uśmiechasz i słuchasz, kurde? Czemu się uśmiechałaś? Czemu się uśmiechałaś?
Książki
Tak,
pomaga.
ciekawe. Tylko widzę z boku. Co się ty uśmiechasz do mnie, co? Powiedz prawdę, czemu się śmiała?
Przyszły ani się pomóc.
No i dobra. Jagoda, jest dzisiaj 26 marca 2025. Dostajesz bana na oglądanie moich YouTube'ów i w ogóle wszystkiego, co tworzę na internecie. Elo.
To spróbuj mi też coś mówić a propos twojego YouTube'a i tak dalej.
Okej, już nic nie będę mówił. Nigdy.
Ale ja chcę, żebyś mówił.
Nie będę mówił.
Będziesz.
Nie będę.
Będziesz.
Nie będę.
Będę.
A muszę coś szybko pokazać. Ani przyszły, ani cię wracam za niedługo.
nawet nie wiem, co robić, co? Nie, nic nie robię. Nie robię. Wyjść, czasem, ty sobie zobaczysz. Olek.
Olek! No i co? Nie lubię.
No i widzisz? Czytam mnie normalnie, a nie formułów. Spójrz na mnie. Nie patrz tego co. Teraz to się stanie, wiem.
Ale ja nic nie mam.
No i dobrze. Tak to jest, jakbyśmy tradowali inne asety, prawda?
Idź w pokoju ananasa.
Nie, mam trade.
No masz trade, a ja jeszcze czekam na jakiś trade. No ale tu już masz trade. Nie, jeden ci wystarczy. Jeden ci wystarczy trade. Co nie? Czat? Jeden trade wystarczy.
Ja, że nie mam ani jednego trade.
Ontdek nieuwe manieren om naar muziek te luisteren met Spotify Premium. Smart Shuffle voegt aanbevolen nummers aan je playlists toe, zodat je nieuwe muziek kan ontdekken. Of geniet samen van muziek door een jam te hosten, waarbij jij en je vrienden nummers kunnen toevoegen om samen naar te luisteren. Tik op de banner voor meer informatie.
Can see who is in control, the bulls or the bears, and the direction the market is likely headed. Ichimoku is a very versatile and informative trading indicator, but you can easily feel overwhelmed by the nature of this indicator if you don't know how to interpret the various lines and shades. Co?
Advanced Simplified Ichimoku Trading Strategy. This is one of the most effective
Hello everyone. How are you? It's Kay. So this is the 13th of
position. In this strategy, you will Advanced Simplified Ichimoku Trading
respected, saying, you know, I like your work or whatever that is, and I would visualize things coming to me that I wanted or whatever. Drive home and think, well, I do have these things, and they're out there. I just don't have a hold of them yet, but they're out there. I wrote myself a check for $10 million for acting services rendered, and I gave myself 5 years, or 3 years maybe, and I dated it Thanksgiving 1995. Just before Thanksgiving 1995,
Ah, yes.
You have the desire and passion for investing, so you expect winning results. But like many investors, format a training and providing the expert guidance you need to make more. The proven trades to your own highlights his top stock picks and explain.
Mi nervini. Sono jak salesman.
Strategy. This is one of the most effective trading strategies as it analyzes all the necessary technical market conditions that every trader needs to consider before opening a position. In this strategy, you will quickly and easily identify market trends. By using this strategy, you can promptly determine which markets are currently suitable and unsuitable for trading. Therefore,
Jak ci to idzie?
Nie powiem ci.
Pokaż.
Nie. Co cię, czemu cię interesuje mój trading? Ja cię nie pytam o twoje trading. Skup się tam.
Słuchaj się, nie ma.
No to ananasa mi krój. Bo ja dwa dni z rzędu obiadek robiłam. Ananaska poproszę.
after following all the contents of this video, you will become a proficient Ichimoku trader. And of course, the most important aspect is that this strategy will enhance the accuracy and profitability of your trading. Without further ado, let's begin our discussion by getting to know and understanding the basics of the Ichimoku Kinko Hyo indicator. Understanding the Ichimoku Kinko Hyo indicator. The Ichimoku Kinko Hyo is a technical indicator that functions as a trend follower, as a quick glance at the chart allows a trader to easily identify the ongoing trend.
Słucham?
Fajnie, poczytałam trochę Toma.
Trend. This indicator utilizes several data points from the past and provides a visual representation of price movement analysis effectively. The Ichimoku Kinko Hyo indicator stands on its own, hence it's also referred to as a trading system usable in stock markets, commodities, and the Forex market for analyzing price movements. It was developed by a Japanese national named Goichi Hisada before the start of World War II. He developed this indicator by hiring numerous students to conduct backtesting, resulting in a perfected indicator as seen today. This indicator was publicly released in 1968 after undergoing a 20-year backtesting process. Ichimoku Kinko Hyo translates to equilibrium chart that can be analyzed at a glance. Goichi Hisada strongly believed that the data visible on the chart reflects the behavior or psychology of people active in the market. By utilizing the analysis of the 5 lines within the Ichimoku Kinko Hyo indicator, a trader is expected to perceive market equilibrium. These 5 lines within the Ichimoku Kinko Hyo do not stand alone. Rather, the information from these lines complements each other, resulting in high probability analysis. Basic forms of Ichimoku Kinko Hyo: Tenkan Sen, Kijun Sen, Chiku Span, Senku Span A, or leading line 1, Senku Span B, or leading line 2. Meanwhile, the distance between Senku Span A and Senku Span B is referred to as the Kumo. From the formulas above, we can conclude that the basic periods of Ichimoku are actually 9, 26, 52. This is quite common as Ichimoku is primarily used to analyze movements that tend to be long-term or have long periods. Nevertheless, it's possible to change the basic periods 9, 26, and 52. How to use Ichimoku Kinko Hyo? Uptrend. The signal strength of an uptrend is strong when: first, the price has crossed the Kijun Sen and Tenkan Sen from below to above, then the price moves above both Kijun Sen and Tenkan Sen. Second, a bullish Kumo has formed. Third, the closing price is above the Kumo. Fourth, Tenkan Sen has crossed Kijun Sen from below to above. Fifth, Tenkan Sen and Kijun Sen are above the Kumo. Sixth, Chiku Span line is above the price in Kumo. Seventh, when initiating an open buy, do it when the distance between the price and Tenkan Sen is not too far. Downtrend. The signal strength
of June 2022, and this is on Monday. So usually on Mondays I take a day off, so usually there's no video on live streams, but today I wanted to share one of the comments on the live stream that I get this question oftentimes. So that's why I wanted to take a video for this topic and explain on this topic. So the question today I would like to answer is actually this one. It's over here. This is from Lukman. He says, hello teacher, have a nice day. I have a question. Does Ichimoku Sanjin or also the Goichi use multiple time frames? Thank you. So back in those days when Goichi Hosoda was there was no PC. So there was no way to look at the multiple time frames. Now we have a PC. So, simply by clicking the different time frames, you can change from a daily chart, 4-hour chart, 1 hour, and lower time frames. But back in those days, there was no PC. So the answer is that he didn't use the multiple time frames. So multiple time frame analysis by Ichimoku is my original and not the original of the Goichi Hosoda is my answer. And to dig a bit deeper than this, actually Ichimoku was invented to just check the daily time frame, but still can see short. Hello. Back in those days, when Goichi Hosoda Kumo, Senko Span B is upper part of the Kumo, and this one shows the long-term market participants. So if the price is below the Senko Span B, that means the market is bearish in its momentum, right? Simply speaking. And then there is a Kijun Sen. Kijun Sen shows the mid-term market momentum. So when the price is below the Kijun Sen, that simply means the market is bearish momentum. And then there's a Tenkan Sen. Tenkan Sen in my chart color setting is a blue. So here's a Tenkan Sen, and Tenkan Sen shows the short term. So simply speaking, when the market is below the Tenkan Sen, that means the market is bearish. And also Chikou Span. Chikou Span technically shows the midterm also, just like the Kijun Sen. So when Chikou span is below the candles, that means the market is bearish. Simply speaking, actually there's more to it, but simply speaking, that's the basic idea. So the idea of Ichimoku is just by looking at one time frame, which is a daily time frame in this case, you know whether the market is bearish or bullish in terms of three different terms: short term, a mid-term, and long term. So in this case, pound USD daily chart, right now the price is below the Kijun Sen, Tenkan Sen, and Kumo, and Chikou span below candles. So simply speaking, it's bearish. So the idea of Ichimoku is to capture the market momentum as of now. And there's nothing else we can do actually. We can't predict the future. We can't expect which way the market might go. The only thing we can do is to understand the market situations of now correctly in terms of three different terms, so that you can capture which way the market is going, and also in which momentum the market is actually bullish or bearish. On these three different terms. So if Goichi Hosoda will look like this kind of market, then he says it's bearish, so you can sell. But as he also mentions on the original books, you can't really trade by the Ichimoku itself only. He always encourages us to also look at the candlesticks, also look at the support and resistances, and always look at the chart in a holistic way and take trades accordingly. So in this case, there's a support level here. The previous support was exactly on the 13th May, around the 1.2147. So you know that the market is very close to support. So in this case, it may retrace, it may bounce. So you better wait for the support level breakout and sell. Yeah, but now this is bearish. So the market tends to go bearish continuously, is what Ichimoku says, right? So let me just give you another example in one single time frame in terms of short term and mid term and long term. So let me check some other pairs. I would like to pick some different situation, like but good example. So let me check. Okay, so here is the USDJPY, and the USDJPY daily time frame is now bullish at a glance because the price is above the Kumo, above the Kijun Sen, and above the Tenkan Sen, and the Chikou span above the price. So this is now bullish at a glance, right? So that means from the short term to mid term to long term, it's bullish. More precisely, the buyers for the long term and short term and mid term are winning, and sellers in the short to mid to long term are losing. That's what it means on these three lines or the 5 lines of Ichimoku. So Goichi Hosoda would encourage us to buy in this case. Never sell, but take a buy. Look for, the buying edge, or look for where to enter the trade to buy, but never sell is the key. So, and also the idea of the Ichimoku is that, let's say the market reverses. So maybe good example would be like this. Previously, we had like a similar situation where a Kumo, a price is above Tenkan Kijun Sen Kumo and Chikou span above candles. It was bullish. But as we monitor the chart, next day, still market is above these lines, so it's bullish. And if I just move for more candles, here, you see the market broke the Tenkan Sen. So simply, this means that as per the original teaching, this means that in a short term, market is becoming bearish. But in the long to mid term, it's still bullish, right? So if you are the short-term participants, if you want to follow the short-term direction, you better sell. But if you are the long-term to mid-term participant, then you can still buy, is what Goichi Hosoda would say. And then as we monitor, the market breaks the Kijun Sen over here. the close price, the candlestick close becomes below the Kijun Sen. So this means that the sellers becomes dominant in the short term, Tenkan Sen, and mid-term Kijun Sen. Price below Tenkan Sen, Kijun Sen. That's what it means. However, the price is still above the Kumo, so that means in the long term, buyers are still dominant, but in the short to mid-term, sellers becomes dominant. So if you are the short-term to mid-term participants, you better look for the sell chance. It's retracing backwards now. But if you are the long-term trader, you can still look for the buy chance. As long as it's above the Kumo, you can still look for the buy chance. That's what Goishosa would say. So like this, the original teaching of Ichimoku is
Koniec tego ananasa?
Zostaw
robisz?
ten telefon.
Czemu ty sobie przed
Dostałem komentarz pod filmem.
Pokaż.
Nie.
Jaki komentarz? Kogo? Pokaż mi. Co do ciebie pisze?
Zostaw.
Pokaż mi, pokaż mi, pokaż mi, pokaż mi,
Uważaj na zegarek.
pokaż mi, pokaż mi,
Chcesz-
pokaż mi.
Chcesz tego ananasa? No to koniec.
Teraz.
Teraz. Masz streama mam. Widzisz, że jestem live i w ogóle. Nie ogląda mnie 5-10 osób i teraz nie mogę wyjść z tego stanowiska tutaj.
Ogląda cię 5-6 osób?
Na pewno,
Pokaż,
na
ile cię
pewno.
ogląda.
Nie.
To byś mi linka zobaczył.
Nie. Słucham o
very simple like this.
Ishimoku. Ej, ogólnie te... pamiętasz te chmury, co mieliśmy na tym? Na Akademii?
Chmury na akademii?
No. No to kurwa te chmury też są tutaj.
Okej.
Od gościa, który 1800 coś wymyślił chmury. A nie oni wymyślili sobie indykator.
1800 też gościu jeszcze żyje, tak?
Nie, już żyje.
Wyszło z tego, co powiedziałeś.
Nie, że gościu wymyślił
A,
strategię jakąś.
no.
1900 chyba 60.
Okej, no to jeszcze może być.
I'll be right back. Idę zrobić te. Ale ja muszę Idę, be right back. Idę pokroić ananas. Wróć, biorę miskę ze sobą. I w sumie kawę też sobie zrobię. Dobra, mordy, kończę streama, bo muszę ziemniaki pokroić. Fuck. Pa.